important disclaimer number 1 and important disclaimer number 2. I encourage you to read these carefully. They will be available on the NZX website. Alternatively, you can contact us at Elevation Capital and we will happily send this presentation to you. This presentation is not designed to be comprehensive or exhaustive. It is designed to give you a snapshot of financial ratios and how you might like to think about them and potentially use them. In terms of any companies referenced are presented for illustrative purposes only. And again, there's no recommendations to invest or anything like that. So with that, I will move through to the next slide. So if we think about the capital markets, we all hear about the capital markets and people talk about it on television. And we put this jigsaw puzzle together for you to explain who are the participants in the capital markets. But today, we want to focus on companies. And the NZX refers to companies as issuers. So if a business wants to raise money from the public, it has 2 avenues. It can sell a share in the business, equity, or it can sell debt or a bond. And you can actually buy and sell bonds on the New Zealand NZX debt market, and you can clearly buy and sell shares on the NZSX exchange. So if you were to buy a share, and sorry to repeat, for those that have just heard this, but a share, you have to understand, is a fractional interest in a business. So it is not some speculative piece of paper. It's not an 8-digit CSN number. It is actually a fractional interest in a business. And so therefore, you have to ask yourself, what would you want to know about the business itself? How would you assess how much you're paying for that share or fractional interest? So there's a variety of ways to evaluate a business using financial ratios, and we've described it as a whole series of cogwheels. But the way we think about it is in two paths: business quality and business price. So we've got to assess business quality and then the price that you're paying. So are you buying a good company? And how much are you paying for it? That's what you've got to ask yourself. So we also, I think this is a really good way, and I think in many ways this is the most important slide in the whole deck. And it's a business quality matrix. And so down here you have cyclicality, and so that is the economic cycle as we know it. And here you have capital intensity. So how much capital is tied up to run the business. And if we focus on utilities, being things like Genesis and Mighty River Power, Meridian Energy, you have low cyclicality. Shouldn't surprise you. We have to buy electricity every day. It's a very stable business in that sense, but very high capital intensity. Dams, power stations, wind turbines, hugely capital intensive. So I think this is a very good slide for anybody to use to think about a business. It's a very simple matrix. And so if we focus on business quality first and how we are going to assess business quality in simple terms, 3 ratios that I want to talk to you about today: return on assets, return on equity, and the debt to equity ratio. So return on assets. ROA is the industry acronym. So return on assets measures how profitable a company is compared to its total assets. So it provides an assessment as to how efficient management is at utilising the company's assets to generate earnings. So it is calculated by dividing a company's annual earnings or net income by its total assets and is therefore expressed as a percentage. Now down underneath we've provided you, just as a footnote, examples, and the examples are consistent all the way through our slides. RBD refers to Restaurant Brands, New Zealand, MRP, Mighty River Power, and XRO, Xero. Okay. Now in terms of return on assets, you can see that Xero has no return on assets, not meaningful, or in terms of the way we've presented it here for you today. Now, all of this data has come from the annual reports and the interim reports and or Thomson Reuters WorldScope database. So in terms of Xero, if you think about it, it's obviously an extremely high profile company in New Zealand, huge success story, but it is a growth company. It is investing heavily for the future, generating losses at the moment as it takes its business around the world in the expectation of profits in the future. So return on assets, not meaningful at the moment. In terms of Mighty River Power, a 2% return on assets shouldn't surprise you, high capital intensity. And then Restaurant Brands, an 18.2% return on assets, nowhere near as capital intensive as Mighty River Power. So return on equity, if we move to this ratio, ROE, measures how much income is generated compared to how much equity investors have invested in the business as well as retained earnings, if any. It is therefore calculated by dividing net income by shareholders' equity. And again, ROE is displayed as a percentage. So if we focus on the companies that we mentioned before, Xero, a growth company, investing for the future, NM. Mighty River Power, a 3.6% return on equity, should not surprise you given the capital intensity of the business. And Restaurant Brands, significantly lower capital intensity, higher return on equity for investors. So all of these ratios you also have to remember cannot really be looked at in isolation. You've got to look at a number of them, and we'll come to that in the second segment of the presentation. But they all are actually quite easy to calculate, and slowly but surely you can build a picture. So if we focus on the debt to equity ratio now, this is a measure of how much debt a business is using to generate its returns on equity. So debt equity is calculated by dividing total debt by shareholders' equity. So people often refer to a company's leverage. Leverage refers to the amount of debt a business has. Debt to equity is one way to look at a company's leverage and how it may also increase the risk to the investor. So you can assess the risk of the investment using this ratio. So again, if we focus on Xero and then followed by MRP, Mighty River Power, Xero should not surprise you, growth company. Debt shouldn't be a feature of a growth company like that. Shareholders are funding, they're raising capital from shareholders to invest into their business. Mighty River Power, we talked about capital intensity. These are big assets. They're very stable cash flows that come off these assets. Shouldn't surprise you then when you think about it that company can carry more debt than a Xero or a Restaurant Brands. Restaurant Brands is obviously focused to the consumer, selling fast food. So, you can work out a picture from just looking at these ratios and standing back and thinking about things sensibly. You can work out a picture of a business. I would encourage you to spend less time listening to CNBC and more time reading annual reports and thinking about businesses this way. And that will stand you in very good stead going forward, in my opinion. So if we move to working out how do I know I'm paying a fair price or a good price for a business, because price is what you pay, value is what you get. Another very important point in investing. Price is what you pay, value is what you get. So now we're going to focus on what's called the price to earnings ratio, the dividend yield, the dividend cover, and that's not something that you hear people talk about a lot, but it's a very important ratio for you as an investor, and the price to book, so the price to book value. So if we focus on the PE, this is a ratio that you will see written up in the newspaper all the time. People refer to it quite regularly. The price to earnings ratio is a measure of how many times earnings someone is prepared to pay for the business. So how many times earnings someone is prepared to pay for the business. It is calculated by dividing the current share price by the earnings per share. And you can see here that Restaurant Brands has a PE ratio of 15.2 times, Mighty River Power 28.3 times, and Xero, not mentionable because it's investing for the future. Its earnings are negative at the moment, and so you have to be focused on the investment for the future and the expectation of a return in some future period. It's a growth company. Whereas Mighty River Power, what does the PE ratio tell us? What it tells me is that people are prepared to pay a higher multiple for the stability of Mighty River Power's earnings. You know, very stable businesses, electricity companies, putting hydrology aside. Again, you know, there's a nuance coming into these things. So your ratios only tell you so much as well. You do have to be mindful of other factors. Versus a Restaurant Brands at 15.2 times. So people are prepared to pay a higher multiple at the moment for Mighty River Power's earnings because of the perceived stability, in my view. So if we move to dividend yield, the dividend yield is a ratio that shows how much a company pays out in dividends each year relative to its share price. In the absence of any capital gains, the dividend yield is a return on investment for a share. So you can see here, Xero, we've touched on it before. Again, we shouldn't be surprised that Xero is not offering us a yield at the moment. They are investing for the future, expectation of profits and building out their business around the world, and you know, maybe you'll get a dividend in future years, but you wouldn't be purchasing Xero on the basis that you were going to get a dividend yield at the moment. Whereas Mighty River Power and Restaurant Brands offer the same yield. Well, what does that tell us? It actually tells us we've got to take a step back and go and look at some of the other ratios and assess the prospects, utilising the other ratios and reading the annual reports to assess Restaurant Brands versus Mighty River Power, because they've got the same yield. Dividend cover, a very important ratio. It indicates the ability for the business to pay its dividend. So it is the ratio of a company's earnings, net income, compared to the dividend paid. It highlights to us whether the dividend is coming out of this year's earnings or not. Are they borrowing to pay the dividend? You know, that could be detrimental to you down the road. So it's calculated as earnings per share divided by dividend per share as well. It's not a ratio that you hear talked about a lot, but it's a very important ratio. And then price to book, the final ratio that I want to talk to you about today before I'm happy to take questions, compares the market value of a share to its accounting value on the balance sheet. Price to book tells you what you are paying for a share versus the equity per share you are receiving. It is calculated by dividing the current share price by shareholders' equity per share or book value. So Xero, again, 13.2 times book value. That shouldn't surprise you for a technology company. They're what's called asset-light companies, low capital intensity, high level of intangible assets and software development and things like that. Whereas Mighty River Power trades at 1 times book value. Capital intensive, dams, all of these kind of things. So all of these ratios, I believe, can really help you formulate a view, part of a view, on, you know, if you were to invest in a particular share or security trading on the NZX or the NYSE for that matter.